Now, earlier on, I spoke about the different ways that VC funds may look to value a company. These included the last round valuation, a comparable company analysis, and the options pricing model. To that, I'm going to add the discounted cash flow model, assuming the startup has some operating track record to apply this method. Perhaps the first term an entrepreneur will hear about the valuation of their company is the pre-money and the post-money valuation. The post-money valuation simply refers to the valuation of the company once the VC funds have invested their money. So if the fund was investing 10 million and the valuation is 50 million post-money, the company is valued at 50 million after it has received the 10 million capital injection. Pre-money obviously then reflects the value of the company before 10 million is invested. Implicitly, that means the pre-money valuation in the example I used earlier would be 40 million. If a fund invests 10 million in company A and owns 20% of the company, what does the company need to look like 5 to 10 years from now to be a meaningful return driver or to be a winner for the fund? Let's say a winner means a return of 10 times. So the fund would want 100 million returned on the original capital investment of 10 million. If the fund owns 20% of company A, then to earn 100 million on its investment, company A needs to be sold or go public for at least 500 million. So if company A was being valued on a comparable company basis and a mature comparable company was trading at a revenue multiple of 5, to achieve a 500 million valuation, company A would need to be generating at least 100 million in revenue. So what would have to go right with company A to hit a revenue of 100 million? Is the targeted market size big enough to support a company with 100 million revenue? What are all the things that could go wrong and cause the company to fail? What are the probabilities regarding all these considerations? This is in practice the maze that VC funds have to navigate when arriving at a valuation. And that's why the industry refers to it as a "what do I need to believe" analysis. Obviously, we're talking about very early stage companies here, where there's very little by way of historical financial metrics which we can use to value the company. As startups become more mature and they have financial statements that are more reliable, the valuation will be based on much more traditional valuation metrics that I mentioned a bit earlier on.